G'day, I'm Pat Cranshaw,
I'm Luke Ashby.
and we're from North Brisbane Home Loans. And this is a quick, catch up on all things to do with buying your first home. So we get a lot of clients asking us for pretty much the same information around what data they need to get across before they buy their first home. So we thought we'd put together a few questions, a bit of a series of information to share with you guys. To help you through your journey, and we look forward to any feedback at all, any questions. Feel free to put them in the comment box or send us an email, and we'll cover off with them as best we can. So enjoy the series of information, and we'll talk to you soon.
So Pat, what do the banks and lenders look at to calculate how much I can borrow?
All right. So yeah, basically they want to know how much income you're bringing into the family, into the household, and then they look at what your actual expenses are going out. And I guess the gap or the middle time in between those two things is how much available to you to be able to service a loan. So things like your gross annual income, the way that you're employed, we'll touch on that later on, but obviously you've got salary people, you've got people on wages, people get overtime, you've got people on contracts, self-employed. So at the end of the day, we work out your gross annual income, and then obviously you take tax off that. If you have any salary sacrifices or anything like that that are compulsory, then that has to also come off your income to determine how much money you've got left at the end of every fortnight, week or month, depending on how you get paid, to cover all your debts. And then they use that, I guess, to assist them determining how much your borrowing capacity is. The other thing that I look at is what your expenses are to run a family or yourself. So if you're a single person on a certain amount of income, there's what they call a household index, in which the banks actually utilize to determine how much they think it costs you to run you. Obviously, if there's two of you and two kids, it's more expensive to run a family of four than it is to run a family of one. So everything's sort of like a little bit dynamic in terms of how many people you have in the household and what that sort of flashes out at. The more income you earn, the more discretionary income you've got to spend on Uber Eats and all the other stuff that can be taken into account as well in terms of how much you spend on your recreation expenses. But we cover off on this when we go through the process to sort of, I guess, become a bit more realistic around, a lot of people think that they can spend, or they spend a certain amount, but then when they start saving for a house, they tighten their belts. And when they have their own home, obviously they don't necessarily spend as much as they used to spend because they've got a home to protect. So so that's all taken into account. They do look at your last 3 months living expenses just to get a feel for what that looks like. So it's important, I guess, to get across that leading into an application, maybe sort of like trim your expenses back a bit, not too much on the old Uber Eats and Ladbrokes accounts or whatever, and look at your liabilities. So things like Afterpays, Zip Pay, credit cards, any personal loans, all that sort of stuff comes into play when they want to know how much they can lend you for your home loan.
And they look at things like credit card limits as well, not actually what you owe on there. They're going off the limits, aren't they?
Yeah, that's right. So if you've got a credit card and it's got a limit of $5,000, let's say 10,000 because it's easy for my maths at the moment. So it's a $10,000 limit. You only owe $1,000 on it. Clearly you can go out and spend another $9,000 on a new couch or whatever you want to spend. So the banks use the limit to determine how much your borrowing capacity is affected by. So it's 3.8% of the limit. So $10,000 is $380 a month that comes directly off your borrowing capacity. Doesn't sound like much, but that's probably about $50,000 to $60,000 in actual home loan that you could drive by not having a credit card at 10 grand. So, obviously if you can deal with a credit card around the $1,000 or $2,000 mark, and you want to increase your borrowing capacity, but these are the conversations that we have with clients at the time of, determining what your borrowing capacity is and seeing what we can tweak to actually maximize that, or, come to some sort of discussion about what it is that you need.
What is a credit score?
So a credit score is something that the banks use actively to determine how you are going to be looked at as a customer of theirs. It's one of the things that they do to make sure that you will pay back their loan. So it's really just a snapshot of your credibility around how you manage credit. So they vary on a score from 0 through to about 1,000 in terms of what that score looks like. Most of the banks are looking for people with a score above 600. The closer you can get to 800 or higher, the better off you'll be. There are some lenders who'll do at 600 or below, but you'll find that they're potentially not the sort of lenders that you would normally want to get a loan from if you could improve your credit score to a degree where it's a lot higher. Yeah.
Yeah. Okay. And so how do I find my credit score?
Yeah, so you can jump online. You can actually get a copy of your credit score once a year through any provider for free. So, but you can jump online to Illion or creditsavvy.com.au. If you come through a broker, sometimes they have access to providers that you can get a credit check done. If you're not too sure about it, if you've had any sort of gee, I wonder if that, when I left that apartment or that unit a while ago, did they fix up the power bill that was in my name? That sort of stuff comes up from time to time. So you don't want any surprises. So you definitely want to get across that and see what it looks like. And then if you do have it, you want to take it to your broker to let them know that, hey, I've got a credit score done and it's 700 or 800, then that's all good. You don't want to get to a stage of applying through to your lender and finding out your credit score was a bit ordinary. You can get them repaired, but it sometimes takes money to get it done, but not more often than not, it just takes time to actually get your credit score to the degree where it needs to be. So pay your debts on time, keep your credit cards under your limits, pay your afterpays on time. All that sort of stuff comes up on active credit reporting. And what I mean by that is that the banks, probably about 80% of them all have active credit reporting where they can actually see everybody's liabilities at any one point in time. So no longer do you have to just sort of tell the bank that you've got 3 credit cards. They know. So you can't hide them either. So we've had clients before that, have either forgotten or they have deliberately, hidden a credit card for whatever reason. It was a secret card that, she didn't know about or he didn't know about. And it came out. So just keep them up to date, keep your savings account in order too. Like if you've got a check account or a savings account that your wages go into, try not to let it go under. I know that they say that they'll cover you and you can, they charge a $10 fee or $25 fee to protect a direct debit payment or something like that because you were short that week. But if it goes into negative, it comes up on the credit score and it has to be $1. So the system or the computers don't recognize whether it's $1 or whether it's $100,000. Basically, you've gone into the red and that triggers the fact that your account conduct for that particular month was not great. So credit score is very important. We do have some lenders that don't do the active credit reporting, so and they will manually assess it. So credit scores are basically one way the banks look at things, but most of the time when it's electronically submitted, the banks look at about 60 to 70 different things, and credit score is one of them. And a lot of the time it's automatically assessed, like computer generated assessed, and sometimes it can be declined straight away. So we do have lenders that we can have conversations with, send applications directly to them. They do a manual assessment, but that's probably only about 15 to 20% of all applications. But it's good to know that there's some, pathways that we can go down to assist clients who may have had a bit of a blip that we need to overcome.
Yeah, no, fantastic.
Why is it important to have a solid record of employment before a loan application?
Yes, well, I guess these days it's all about income. So like you can have a $200,000 deposit, but if you can't afford to pay back a $400,000 home loan, it doesn't matter. Like at the end of the day, the banks are looking at income to be able to sign off on what it is that they can approve to have it paid off over maybe a 30-year term. So having a stable period of employment signifies to a bank that you are stable, like you haven't changed your job 8 times in 12 months, so they don't want to be, left with making a decision about giving somebody some money to find out that, they didn't like that job and they pulled out of it, and then they were 3 months without work and you went into hardship and yada, yada, yada. So look, at the end of the day, most of them want to see a minimum of 6 months in your current job, especially if you're casual. But if you're a full-time or permanent employee, you can get away with as little as a couple of weeks in your current job, as long as you've had prior industry experience for more than maybe 12 months in that field. So every situation is different. Every person's different. If you've got a couple and one of you's been stable for a long time and the other person's only just been recently casual or something, and most of it can be relied upon the main applicant, then again, that's a different scenario. We might be able to sort of dress that up. It depends on how much deposit you've got as well. So if you've got a 20% deposit, you're less likely of a risk, than a higher loan value ratio with a small deposit. But at the end of the day, it's just really important to make sure that when you come to us to discuss your loan application, that your employment's pretty sound.
So, Pat, if I'm on probation, are there options out there for me?
Yeah, definitely. So we've got a lot of lenders. A lot of the major lenders don't have too many issues with probation. The main thing with probation, it relates to how long you've had in a particular industry. So if you were, a chef, and then you stopped and then you started a new role and you're on probation and you're in IT, then that's completely different than if you were a cook and you stopped and then you became a chef, like you stepped up in the same industry, So yeah, look, it comes back to the individual situation, but normally that would be what it would be driven by. And we've done deals where we've had customers who have got a contract in their new role. They've had industry experience previous, they've been in that particular position for 1 or 2 years or more, and we've had approval pending them receiving one payslip. So they only had to be in their role for one cycle of their employment. So if they get paid weekly, we just need 1 week. If they get paid fortnightly, we need one fortnight's payslip, monthly, 1 month's payslip. But if you're a first home buyer, depends again on your deposit and whether or not you've been in the same industry. Again, that would be okay. It'd still be okay. We'll still find you somewhere to go. So yeah, that's pretty much how we cover off on probation these days.
Mm-hmm. And there's no real difference in terms of the lenders and their rates when looking at probation? No,
not at all. No, they'll still give you exactly the same rate as if you were, full-time for 5 years. So, once you meet that condition, you still get the same rate. So it's all good. Look, there are some lenders out there, if you're self-employed or if you had maybe some credit impairment or something like that and you're on probation, yes, they do 1 or 2 days employment, 1 or 2 days casual and stuff like that. Those rates, in the current market, if the rate's like 2.5%, you're probably paying 3.5%. So, 1% doesn't sound like a lot, but, on a loan of 400,000 over a long period of time, it adds up. So, I'll probably wait and until such time as you met the condition by any lender for your situation to go to a RIGI lender and have a lower rate. But again, everybody's situation is different and is driven by what's going on, the policies and what happened in behind the scenes in terms of their credit and stuff like that. So it always pays to have a chat with a broker to get across exactly what your situation is, and then we can tailor a solution to suit. So, Luke, tell me a little bit about genuine savings. What it all means. It's very confusing in the marketplace. People think you just need 5% deposit, 2% deposit. Like, what does it actually mean?
Yeah, Pat, it's not as easy as that, unfortunately. With most lenders, they want to see that you've got at least 5% of the purchase price genuinely saved and inside your account, and also added to over a period of 3 months. So yeah, look, if you've had a transfer from mum and dad, it's just hit the bank account, even though if it's 5% of the purchase price, the bank will need to see that there's evidence that you're able to save over that 3 months, and the money hasn't changed, it's actually built over that time, to then pass that criteria.
Is that mainly around the banks wanting to see some hurt or some regular savings patterns? Yeah.
Yeah, no, absolutely. They want to make sure that, yeah, obviously you've got good conduct, you're able to make your payments, you're able to meet, you're able to save each week or each pay, so that you're
On top of your existing liabilities, on top of everything else you've got going on.
Yeah, exactly. And the banks will also look at things like your rental ledger as well, if you're renting through an agency or through a private agreement with some lenders.
Some lenders, yeah.
Yeah. So it's a case by case basis, and if you're not sure, obviously speak to your broker. But there are options out there to sort of get around that 5% genuinely saved. If it is a gift from mum and dad, or you've received an inheritance or things like that.
Yeah. So really it's 5% is probably not quite right. It's closer to 8% in reality, because you've got mortgage insurance, don't you, to make sure that you come under 95%. So 100% is your loan amount, 5% is your genuine savings, and then you've got fees, sometimes transfer fees. If you're buying a house over 500,000 in Queensland, you've got stamp duties over and above that you have to pay as well, pest and building. So it does add up pretty quick. So people are often sort of like a bit surprised by the amount of money they physically have to save in order to proceed.
Yeah, especially if you're aiming for something under 500,000. I like to say to my clients, aim for about 8% of the purchase price to allow you to the 5% genuinely saved, plus about 3% worth of fees.
Yeah, no, that's all good to know. But if you can come up with 10%,
even better.
It is better, and sometimes that doesn't have to be genuinely saved. So we do have lenders, if you've got 10% deposit, that doesn't have to be genuinely saved, doesn't have to be in your account for 3 months. So yeah, this is why you talk to a broker. We can massage it and put it together in the best way for you and your situation.
So what is lender's mortgage insurance, or LMI, as you might hear sometimes?
Yes, so yeah, jargon everywhere these days, and especially in our world. But lender's mortgage insurance, or LMI, is basically an insurance that protects the bank. So some people get confused thinking they've got mortgage protection and stuff like that to protect from trauma or disability or something like that. It's got nothing to do with that. It's not personal insurance. So basically, every bank has got within their policies, and their shareholders will actually allow them to write up to 80% or of LVR. So you've got to have 20% deposit, so an 80% LVR on any residential property across Australia. As soon as they go above 80%, so an 81% loan up to 95% loan, they can either self-insure it, or they pay a premium to a mortgage insurer to protect the bank in case they have to sell the property and they only get 80% of its value back. So say, for example, you buy a house for 500,000, you've got 20% deposit, so you can borrow 400,000. There's no mortgage insurance to pay. Yep. So if they sell the house, that's why they do an 80% LVR, because if they have to sell a house, normally the person hasn't looked after it very well. There's lack of communication. They can't be rats, whatever happens. They have to sell the property as a fire sale, and they might only get 80% of its actual real value just to move it on within 60 or 90 days. The banks are in the business of being in business. They're not there to help people get into home loans. Let's be clear about this. They're there for their bottom line. So if they sell the property, they want to make sure that they get all of their money back. So when you've got a 10% deposit, so say you've got $50,000 to do the same deal, you're borrowing $450,000, so you've got a 90% LVR. If there's an insurance premium that's paid by the customer directly to a mortgage insurer like Genworth or QBE, or some banks have their own mortgage insurance company, it's a one-off payment that gets added to the loan or inside of the loan. It can be $2,000, it can be $25,000. It depends on the loan value ratio, the size of the loan. It's like on a sliding scale. But anyway, you pay that. that goes to the mortgage insurer. And in the event that something happens, touch wood, it doesn't happen, but in the event that it does and the bank has to sell your property, and instead of getting that 450 for it, they get 400 for it because they only sold it and they got 80% of its value, but they gave you 90%. They go to the mortgage insurer gives them that extra 50,000 plus costs because the insurance premium was paid. The mortgage insurer will then swing around and actually go back to the customer afterwards and say, hey, you owe us 50,000 still. So look, that's the picture of it, I guess. But at the end of the day, you know, for somebody to save $100,000 for a deposit to buy a $500,000 house, and they're renting at the same time, they might have kids, all that sort of stuff, it takes ages. Like, it would take a long, long time. So unless you've got a family situation, a guarantor, a gift, or you're really diligent and you can save, most people take advantage of mortgage insurance. Like, let's be clear, it's a fantastic product, it's a fantastic feature. It allows people to get into the market a lot earlier than what they would normally be able to get into it. So, you know, for most people, if it's an 85% LVR, they've got 15%, even up to 90%. If the loan value is not too high, you're looking at $7,000, $8,000, maybe $10,000, you know, at the most. So when you annualize that out and you look at it over the cost of actually the transaction, it's not a big amount. And it does allow people to get into the market earlier. So if the market's sort of moving away, you know, we often have these conversations with people, I just want to get in now. So they're happy to pay that little premium to be able to enter the market. So tell me about gifts. So mum and dad want to give me, you know, 10% deposit or a gift to help me into my first home. Aren't I lucky?
Yes.
How does that work? How does that play out?
All right, fantastic. So depending on the lender, they want to see some evidence for this gift. So depending on the lender, they want to see either a gift form, a statutory declaration, or they've got their own gift letter, which is part of their own policy. So they just want to cover off on the fact that it is a non-repayable gift, and they want to know where it's come from, obviously how much it is, and things like that. So yeah, depending on the lender as to what process we need to go down for that. But yeah, obviously.
So why does it have to be non-repayable? Why is that?
Needs to be stated that it's non-repayable and signed off by mum and dad, because if not, the bank will see that as a liability and it can affect your servicing moving forward.
Right. Okay. No worries.
So yeah, depending on the size of the deposit and if you've got genuine savings yourself, if you don't have genuinely saved 5%, and the deposit, the gift from mum and dad is 10%, we do have lenders that don't need to see genuine savings. So there are options out there depending on the size of the gift.
Right. Okay. And I guess we're comparing a gift to maybe a guarantor. A gift is basically a one-off payment. Mum and dad's liabilities just in the gift. There's no contingent liability to be, you know, attached to their home or anything like that. So for some mums and dads, it makes sense for them just to give, you know, Jane and Johnny 50,000 or 25,000 or 30,000 rather than having it attached to their home. So those are the two scenarios basically where mums and dads can help, or family members can help their kids into the market. Yeah.
Yeah, no, absolutely. So there are options out there. Obviously, if mum and dad have got the cash behind them to put the gift down, personally, that would be the way that I would go about it. But obviously, it comes down to your own personal situation and how, yeah, we can best get you into the market. So Pat, I'm a first home buyer. Mum and dad are willing to help by way of a guarantor loan. Now, I'm just wondering, how do they work?
Well, they are a fantastic way for mum and dad to actually help. One of the key reasons that it's a good idea for mum and dad to do it in terms of physically being able to help and assist is that you can only get approved for a home loan based on your own income. So it's really mum and dad's security property. It can be their own home, it can be an investment property. So as long as they've got sufficient equity inside of that property, they might be worth 600,000, they might only owe 200,000 on it or something. So a bank takes a second charge or a second mortgage in behind their existing mortgage, basically. So, for example, if it's a $500,000 purchase, a bank will give them, we talked about 80%, 20% ratios in terms of what the banks are happy to go to. So 80% would be on the property that you're buying as your first home, and then 20% would be secured against mum and dad's property. And what that means is that they don't physically have to come up with any cash. So as parents get older and stuff like that, there might be pensions involved and superannuation and bits and pieces. If they start whipping money out of their mortgage and they gift it to people, or they, sometimes it can be considered as a deeming issue in terms of like their pensions and stuff like that. So if they're comfortable with the risk associated with the bank registering a mortgage against their property, then it is a great way for clients to be able to get into the marketplace without paying mortgage insurance at all.
Okay. And do I still need to have a deposit?
Look, you don't actually. Like ideally, it would be great if you could show your parents and also the bank that you do have some capacity and willingness to contribute something towards the transaction. I think that's always a good thing to see some hurt money in the game, because it just shows all parties that you're invested in the process as well. But people's situations change. People separate. Sometimes their money disappears through different ways and stuff, so they just don't have a deposit. So we're not here to judge anybody. At the end of the day, if they want to buy a property and mum and dad are happy to use their property as security, and by the way, it doesn't just have to be mum and dad, it can be a related party, grandparents, siblings and stuff like that with some lenders, but most of the time it's mum and dad. You can certainly look at borrowing. I think it's around basically the purchase price plus costs. So we do have questions, or can I roll my existing bike loan or car loan into it as well? No, you can't. At the end of the day, you're basically buying a house. It's not there as a big safety net to wrap all your debts up into the one nice tidy loan. Used to happen, doesn't happen anymore. So you can wrap it all up into the one loan. Different banks have a slightly different approach to the way that they look at it. But most of the time it's just that 20% from mum and dad and 80% on your property. Normally there's independent legal advice that need to be provided to the parents as well. So everybody's on the same page. We have communication with you and also with them independently. So, we make sure that they're fully up to speed and not feeling coerced or, feeling under pressure to make a decision. And people need space. They need time to be able to digest the information that's provided, because it's a pretty big decision. You're talking about, $100,000, $200,000 of registered interest in their property. So, it needs to make sense. But we really just talk to all parties about having some sort of exit strategy. So, if you buy a property in the right place at the right time, normally it'll start to appreciate in value. So look, at the end of the day, if the property has to be sold, you'd hope that it would be sold for the same money that you purchased it for, if not a little bit more. So, in 3 to 5 years' time, the risk may be that if they do have to sell the property, that there isn't a gap that would have to be made up. And some banks, if that's the case, they want to make sure that mum and dad have got a little bit of money behind them, so they don't have to sell their house in order to, meet the debt sort of thing. So, we just basically have a conversation around that, and maybe we escalate and increase the repayments on the kids' portion of the loan to increase their equity, because we've got clients that, once you get to 20% equity on the property that you own, then you can ask the bank to release the mortgage on mum and dad's property, and everybody's happy and go your own separate ways. I mean, we want to cut that umbilical cord as soon as possible, if possible. Nobody wants to be tied to each other for longer than they need to. So, but if you can get to 10%, like mortgage insurance at 10%, it's a hell of a lot cheaper than it is at 5% or 95% LVR. So that would be the first initial aim, is to get to 10%, and then you can review things then. If mum and dad are happy and you're happy, you can continue down that path. But we're always happy to have a conversation about the options around refinancing and, moving away from that. Everybody's situation's different though, so we just basically have to have conversations with all parties and make sure that they're comfortable with it.
Okay. And having mum and dad as guarantor or grandmother or sister or whoever, does that increase my borrowing capacity at all?
Unfortunately not. No. So guarantors are there only for collateral, not capacity. So basically they're there for security purposes only. The bank wants to make sure that you and your partner can service the loan by yourselves without any impact on any other person. So if the bank won't give you the loan, they're not going to give you the loan with a guarantor. So basically the property needs to be sound that they're providing, and their situation needs to be sound in terms of their financial position. But we don't actually use any of their income to be able to support the whole scenario. And saying that, what can happen and what you could do is that in the event that things start to go a little bit pear-shaped, one of you lose your job or something like that, obviously it would be in your best interest to communicate to mum and dad that, hey, we're struggling a little bit or whatever. At that particular point in time, they might be happy just to give you $100 a month or something just to prop things up for 2 months until you get back on your feet or something. But the bank doesn't rely on it. So I'm just talking generally there about, in the real world, what might sort of eventuate in the event that hardship was potentially happening. But at the end of the day, I've been doing this for 20 years and I haven't actually had any of that sort of situation happen, which is, touch wood, good to know.
Yeah, no, thank you for that.
All right, so as a first home buyer, mate, there's a ton of support that's been sort of released, some that's been in place for a while and some that's come out since COVID or just after to support first home buyers getting into the market. Can you tell us a little bit about these grants and how they impact people looking at buying their first homes?
Yeah, so that's right. Depending on whether you're looking to build or buy existing, if you are looking to build, there are a couple of little initiatives supported by the government at the moment, such as the First Home Loan Deposit Scheme. Now, this is for new builds only. Basically, if you've got as little as 5% deposit of the purchase price up to $650, I believe, in Queensland, then basically the government will guarantee the remaining 15% of the loan value ratio, so that you're not paying lender's mortgage insurance, and you're also able to get into the market much earlier and build your first home. Now, with that scheme as well is the $15,000 first homeowners grant, so that is also applicable. So that's an additional $15,000 on top of your 5% of the build cost, the purchase price, to be used.
They can go towards your costs and stuff. So the point there, though, mate, is that the $15,000 can't be used towards your 5% gen. It can only be used to support, I guess, some other costs around like legals and stuff like that. Clearly, there's no mortgage insurance, which is good, but there may be some stamp duties and stuff, or there will be potentially, depending on the purchase price of the land. Because as we mentioned before, up to $500,000 for an existing property, you don't pay stamp duty. That's like a first home buyer's stamp duty concession. But if you buy property for land at $200,000, I don't think there's any stamp duty on that. But if you're buying land sort of $250,000, $260,000, $270,000, and then building on top, there is stamp duty to pay.
Yes. Now, Pat, there's also something to do with super and first home buyers to help get them into the market. Are you able to elaborate a little bit more about that?
Yeah, absolutely. Being a first home buyer, there's so many of these different schemes out there. It's hard to sort of get your mouth around some of them. But this one's called the First Home Super Saver Scheme. Say that 1,000 times and you'll be good to go. So it's otherwise known as the FHSS. Anyway, what it is obviously we're all putting money away in our super. And what the government did in 2017-18 was to allow people to utilise their contributions inside of their super or extra contributions inside of their super towards a deposit to go towards their first home. So basically what you need to do is put up to $15,000 of any of your voluntary contributions. So you can actually make voluntary contributions into your super scheme. The benefit of that is that you're only paying tax, I think, at a much lower rate. So it's about 15% that you're paying into your super, which means when you get it out, it's actually a little bit more tax effective for you. And you can use that up to $30,000 across, a few years as your deposit to go towards your first home. So it can help in conjunction with your normal saving to get to a stage where you've got much more deposit. So yeah, you have to be obviously over 18, never own property in Australia, and each one is assessed on an individual basis. But yeah, so it's good. We've had a number of clients utilize that scheme, and they've been able to tap into, I guess, a way that they can access money without sort of feeling like they're saving, if you know what I mean. So, teachers, nurses, or anybody really that can salary sacrifice their super, what you've got left at your end of every fortnight is what you spend. That's what you sort of run the family. That's what you use your expenses on and stuff like that. So if you start getting used to that, like that's the money that I've got, that's all I've got, because you've paid yourself first, like you've saved yourself first by putting money directly into super. So it goes into your super before you get your money. Before you know it, in a couple of years' time, you could have, $15,000, $20,000 without a lot of thought. So yeah, it actually is quite a good scheme, and for people who lean into it, it's quite a tax-effective scheme.
So Pat, how much exactly do I need as a deposit? Like, how does it all work?
Yeah, good question. Probably the best thing to do would be to show people a couple of examples so you can actually see what it sort of like plays out like. So what I'll do is I'll share a screen and give you a little bit of an insight into the workings, how it all works. So can you see this okay?
Yes. Yep.
Fantastic. So this is the funding position. So you'll get this from us if you engage our services, just to sort of go through and give you some idea, I guess, around about the costs associated with purchasing a new property. So let's just put this down. Mickey and Minnie are looking at buying their first home. So I'll put that for a purchase. Okay. First time purchase, we're looking at a $500,000 purchase price. As you can see, there is no stamp duty here. If that was 550,000, 555, you're paying $10,000, $11,000 in stamp duty. But up to 500,000 for an existing property, there is no stamp duty. There are some costs down here that you can't get away from: transfer fees, registration fees. We also put in place some costs around the legal costs in terms of like processing of conveyancing and the solicitors to, check things and obviously turn up for settlement on your behalf and stuff like that. So that's roughly the cost, about $1,800. And then we'd like to put about $1,000 of bits and pieces just to cover off things like pest and building and bits and pieces in there. So, your total costs without even your deposit or mortgage insurance is just shy of $5,000 to start with. So let's just say that we're wanting to do a 95% purchase. So some people would think, okay, all good. All I need is $30,000 because you've got 5%, which is your 25,000 as your 5% deposit. Then you've got these costs down here at 4,000, all adds up to 29,300. So that basically says, oh, I only have to come up with $30,000 to get myself into, a $500,000 purchase. Unfortunately, we need to cover off on mortgage insurance, which is another topic that we've covered before. But basically, if you don't have 20% deposit, you do have to pay mortgage insurance. And the mortgage insurance cost is significant when it gets above 95%, and also impacts the rate. So what we have to do, as you can see down here, is we have to adjust it so the total cost of the loan comes in under 95%. So we basically have to play with these figures. So I'm just going to play with this a little bit, 91%, and then we go for mortgage insurance. We pick mortgage insurance based on the lender that we're going to be taking you to, but we'll basically just pick one a little bit like middle of the road. I'm going to add the mortgage insurance to the loan. So see how it gets us to 94.0% with mortgage insurance. So it takes us under 95%, which means that increases your deposit. So you actually have to have about 47,000 to make sure that you fall under 95%. Now there are some brokers, there are some lenders out there who will allow you to go to 95% and add the mortgage insurance to it. But like I showed you before, there's a couple of things there. If it was 95%, for a start, all these lenders don't actually do 95%, but the cost is another $7,000 anyway, another $6,000 on top. And if you did do it, there's lenders like Liberty and stuff like that. They will do it, but the rate's going to be 4% or higher. And at 95% at the moment, you can get a fixed rate still under 3%. Sometimes, well, definitely under 2%, can't you? With some of the lenders like Westpac and CommBank and stuff like that. So. So that shows you one for 500,000 as an existing purchase, obviously in Queensland, for an established home. So let's zero this out and see what it would look like for what do you want to look at? A land purchase maybe?
Yeah, house and land, 500,000 total.
Total, okay. So we have to go over here and go vacant land, and let's just say that the land is 230,000. And you're going to be building, it's going to cost you 270. So under 230, well, 230,000, you've got obviously no stamp duty to pay. But if that was 250,000, the stamp duty starts to come up, I think. Or maybe it's a bit more.
It's a bit over 250.
260,000. There we go. It starts kicking in around about 260,000. So I'll leave it as it is at 230 just for argument's sake to see what that looks like. So we've got fund here. We've got the first home buyers grant, which is 15,000, for a new property.
Yeah.
So 15,000 for a new property, and then legal fees and so forth are all the same as well. So we're looking at an overall scenario of the 91%, which basically reduces your deposit down to 31,000, which makes a big difference, hey?
Yeah.
But you still have to have 5% across the lot. So you need to have at least 25,000 in terms of being genuine saved. And then if you've got another 5,000 or 6,000, that can come from a gift or something like that. But you still need to have around 31,000 to get into a house and have it constructed. Where are we? Mortgage insurance, eh? Probably need to cover off on that. So the mortgage insurance, yes, up around that 94% mark. So it still works in respect to that. So there's a couple of scenarios there. What else? Any other scenarios you want to run past there?
What would it look like if I was to get on the first home loan deposit scheme and just had the 5%?
You just had the 5%, so there wouldn't be any mortgage insurance there.
No.
Okay, so we get rid of the mortgage insurance. If you had the 5% deposit.
Yeah.
So we could go up to 95 here, couldn't we?
Yep. Which
means that because of the 2015, so you still have to have your 25, but wouldn't you?
Yes. Yeah.
So let me just see what that looks like. So basically what that would look like would be, let's just say it's 25,000 across the two. You would have funds left over and you'd be in surplus. So what basically, so how would that play out? You've done a lot of these. How does that play out there?
Yeah, so being able to use the first homeowners grant, basically we could reduce the loan value ratio and not have such a large loan at the end of the day, because you do have access to the extra 15,000. So
so we just bring this back down a little bit to a more appropriate level.
Yeah.
Maybe give you $1,000 left over.
Yeah.
So it basically reduces your loan amount down to 465. So it does make quite a big difference. Because obviously the less you owe, the less you have to pay back. So you can do it either two ways. You could actually borrow up to 95 and obviously use that extra money to finish the house or do some stuff around the place, or reduce the loan value ratio to get it back. So I guess everybody's situation is different, isn't it, in terms of where they're at. And so it's important for us to have those conversations to understand what it is people are trying to achieve. And then we can structure and look at different funding positions, obviously taking into account their borrowing capacity. But mainly it comes back to where the savings are coming from for first home buyers. That's normally the stumbling block is, how do I get into the market? I'm paying rent, I'm doing this, so, it's hard to save, or, I have to move back into mum and dad's for 3 months to save the money or wherever. So I guess if you know the target you have to hit, it makes it easier. You can just tick it off every month and you're getting closer towards your goal. But if you don't know where you're heading, don't have a plan, then it's very hard to manage.
Yes. Yeah.
Monitor. So yeah, suggest anybody who's looking at purchasing, want to get across their numbers to reach out. We can do some complementary funding positions to give you an idea about where you're heading, and take it from there.
So Pat, tell me a bit about borrowing capacity and how banks look at certain liabilities, and also how can I pre-position myself before I actually apply for a loan?
Yep, good question. It's all about income these days. You know, you can have a really big deposit, but if you don't have a stable form of income, or if you've got too many other additional liabilities, it can make a big difference to how much you can borrow. So I'll share my screen. I'll go through a couple of scenarios, I guess, so you can get a feel for exactly what the banks sort of do look at, and what the impact things like credit cards, personal loans, you know, somebody dropping back to part-time income, one dependent versus three dependents. Yeah, we'll do a couple of scenarios and yeah, see what that sort of plays out like, and take it from there. So I'll just see if I can share the screen with you. You got me there?
Yep.
All right. So for all of our clients, we basically have to go through this process in terms of determining how much income that they've got, which is clearly why we ask for things like pay slips and PAYG summaries. If you're self-employed, there's a lot of information we need to sort of get to, you know, come to this figure here. There's all sorts of different income types, and the banks look at different income types. So, for example, overtime allowances and stuff like that, they take only 80% of. So that's why we ask a lot of questions to get an understanding about what is the income stream for the family.
Just
So
on that,
yeah.
Just on that, Pat, with family allowance, the banks look at that, and can that be useful? Like, do mortgage brokers need to know about that?
Yeah, absolutely. Yeah. So your family tax A and tax B, you know, most lenders will use that up until a child of age 13, 12 or 13. Some of them will go a little bit longer, but basically they want to make sure that there's going to be some continuity of income. So I guess if you've got a 15-year-old and you're getting family tax payments, you've only really got 1 or 2 years left before the government turns that tap off, which means that, you know, a bank needs to make sure that there's going to be enough income to be able to pay the loan back over a period of time. So, but yeah, definitely, and it needs to be geared to the amount of money that you're earning. You know, you can't have family tax benefits assessed at 50,000. You're actually only you paid 100,000 because you got to pay it back, obviously, at some stage. So, anyway, let's just have a look at here. So we've got Mickey and Minnie. They don't have any dependents yet, so they're living the high life. They don't have any expenses whatsoever in terms of liabilities at this stage, so they are good to go pretty much. And as you can see over here, they've got a borrowing capacity of somewhere between, you know, $900 and $1 million. Now, this in itself is a little bit of a furphy, because what we have to take into account, regardless of what these figures look like over here, is that there's this magical thing called a DTI. It's a debt to income ratio, and it's only come in the last 6 months where the banks are really focusing on this. And what it is, it's the gross annual income for the family can't exceed 6 times for the loan. So there's 75 each, so it's 150,000 gross times 6. So the maximum loan that most lenders, probably about 80 to 90% of lenders, will go to is going to be 900,000. So even though these lenders up here are saying we'll give you 1.1, 1.2, in reality, you're down under 9, to be fair. And look, nobody wants to be maxing out how much they can borrow at 2%, because if the rates go higher, you got to pay that bloody loan back, you know. So let's be fair. We want to make people comfortable when they're getting into paying down their debt. And so let's just look at this here. I just want to show you something here. Look at Bank West, for example. They've got an assessment rate here of 5.1. So basically what that's meaning is that even though they're going to give you money at under 3%, maybe even 2% for a fixed rate, they will assess your loan at 5.1%, just in case the rates, or not just in case, when the rates start to rise, you can still maintain a loan payment in their eyes of, under that 900,000, but up to $1 million in their eyes at the stage. So these figures down here, these 5.75, 6.04, 5.33, for example, they are the assessment rates. They are not the rates that the banks are going to be giving you for your loan. They are how they assess it. And the other thing that people have to take into account is living expenses. So you can see that most of these are around about 3.6. Some of them are 3.3. So that's because we've got two people earning reasonable money between the two of them. They don't have any other liabilities or children. So their discretionary income, the amount of money that they can save or spend every month, is going to be more than somebody who's on, let's just put 40,000. So let's watch this figure over here change. It was 3.6. Now it's 2.6. So it's basically
quite a bit of a difference.
A big difference. Well, there's another, was it 35,000 each that they can spend on stuff over and above, paying their normal expenses. So it does make a big difference. Let's have a quick look at what a family looks like in terms of the borrowing capacity. So let's stick down here with ING just to use them as a bit of a guide here. So 984. How much will one dependent reduce their borrowing capacity by? 984. Taking the time, aren't we? 984 down to 936.
50,000.
Yep, that kid just cost you 50 grand. So obviously it makes a big difference if you got three. It does significantly make a difference, and I'll show you the reason why. So that got three kids down to 855. Now that is because living expenses go up to 4,400. So that's what the banks are using. Like you might live off 3 grand a month, but the bank's going to use 4,400. That's the minimum amount that they will use. If you come to us and say we actually spend 4,500, then we have to actually put your living expenses in here. Where's living expenses? There it is. Monthly, 4,500. If we say it's 4,500, you'll see a lot of these figures now change to 4,500, and it reduces significantly what the borrowing capacity will be. Because let's see here, see how these here. So Macquarie, for example, they're above. So their HEM's 4,581, so they didn't move. But these lenders, their HEM's obviously a little bit lower. So the main thing there, I guess, is sharpening your spending over the 3 months leading into purchasing a property to make that more realistic in terms of what your expenses will be after you've purchased the property. Because if we get bank statements in and they say 5 or 6 grand a month, then we put that into here and it makes a significant difference. I'll do that in a minute. Let's have a look at some credit cards and some other things. So most people have a car loan of description and a credit card. So let's just put something in here just to make this a little bit more realistic for some of our clients that we've got. So let's just say they've got a credit card of 5 grand and a car loan that they pay back at $600 a month. We'll use Bank West here, so 955, and we'll go to 2 dependents. So 2 dependents with those liabilities in play sees a maximum loan amount of 868. So it does make a bit of a difference. And because this figure here, they use 3.8% of the limit. So 5,000 times 3.8%, it's $190, $200 a month that comes off your borrowing capacity. So if you've got more than one credit card, and maybe this credit card limit is 10,000. Let's see what that makes a difference. So that was nearly what, $90,000, wasn't it?
Yeah.
It was 868 minus 798, so it's 70 grand. So a $10,000 facility drops your borrowing capacity by about $70,000. So
if I've got if I've got a $10,000 credit card limit and I've got a zero balance, there's no point in having it if I'm looking for a home loan. I'm wanting to expand my borrowing capacity.
If you need to, if you need to borrow more, if you need to have a higher borrowing capacity, then definitely you'd be wanting to get rid of that credit card if you can afford to basically just use the one facility. So yeah, that's very important. And in terms of, I guess, any other expenses and stuff like that, Afterpay obviously is taken into account as well. That's sort of used like a credit card as well for some lenders. So you need to be aware of those types of questions and liabilities when you're looking at going for a loan. Things like HECS as well. HECS, depending on your income, it's a sliding scale, and also super. So some people get paid 75,000 plus super. Some people get paid 75,000 including super. So if it's including super, that's 75,000. It's going to be 10% soon. So it makes it easy for us to work out, which basically takes us back to 67,500. So you can see that all of these types of scenarios and impacts drive basically what your borrowing capacity will be. And that's why we have to ask a fair amount of questions to get across all of that to make sure that when we submit a loan to a lender, we've got the best chance of getting an approval for you.
And it's important that, obviously the clients are being upfront and honest about all liabilities, because as you can see, makes quite a big difference if there's another $10,000 credit card that we didn't know about, or a car loan or personal loan. Those sort of things can sort of make or break a deal sometimes.
Well, not only can that be a bit of a waste in a credit application, because quite often you'll get to a stage where you submit an application, and if you find out about those things afterwards, then it can be declined. It can also be looked at as an undisclosed debt, so it's not actually looked at very favourably by a lender because they think that you're not telling the truth. But most lenders have active credit reporting, so they actually know straight away that there's 2 or 3 other liabilities that are in the mix that haven't been disclosed or have been forgotten. Like often clients just forget. They just haven't used a card for a while. They zeroed out the Harvey Norman. They paid down to 0%. They haven't been making any payments. They haven't come out of their accounts. They haven't seen it, so they haven't remembered. We had a situation where somebody, a guy bought an engagement ring and he put it on credit with the jeweler, and he forgot about it. It's been coming out, but it wasn't something that she knew about clearly. So those types of things you need to be across, because it is a facility. It needs to be taken into account. So very important for us to have those open and good conversations with clients, just to get a better understanding of exactly where they are.
Thanks for that. So Pat, I'm looking to buy my first home. Is there anything to be aware of in terms of the size of the property and also the postcode or location?
Yeah, so normally not relating to house purchases, normally relating to units. So there are a few postcodes, especially in a city suburbs. In Brisbane, for example, there's places like New Farm, Tenerife, the CBD itself, parts of West End, the Gabba, and even as far out as Nunda sometimes. So each lender has their own tolerance, I guess, in terms of risk that they can have in any one particular postcode area, and sometimes even in any one particular development. So it is sometimes can be a bit unique in terms of the way that plays out. Most of the lenders have a postcode tool locator, so we punch the postcode in. It'll tell us whether or not the loan value ratio has been restricted, or if they're not prepared to do any lending in that area at all. So normally with a postcode restriction in a unit complex, in say a postcode that they feel is they've either got too much exposure in, or they've sold properties and they haven't got their money back on. That's pretty much the case. They went to 90% or 95% on a unit block, and then somebody defaulted and they had to sell it, and they only got 70%. So once that sort of thing starts to happen, that's when those criteria. So come in. I would imagine most of them are not in mortgage insurance territory, so you would normally have to have at least 20% deposit to fund those types of ones. But yeah, just contact your broker. We can run through the postcode tool to find out exactly. It's dynamic. It changes all the time. Another thing that people may not be aware of, mate, as well, is that sometimes a lender might have overexposure in an actual unit block, even in suburbia. So, for example, you might have, let's just use ING for an example. They may have 13 apartments out of a complex of 30 that they've funded. They keep record of all this stuff. So once it gets to a certain threshold, they say, no, we're done. We don't want to be overexposed in that apartment block. So we just won't do the deal for that customer on that security property. Nothing to do with their income, nothing to do with their credit or anything. It's just specifically about the security property. And you don't know that. You don't know that
hurdle
until you've actually submitted the valuation. Application goes into credit looks at it. Yeah, the final hurdle, exactly, where they've actually done the actual assessment. So that's a key thing to be aware of, just in the back of your mind. Very rarely happens. It's like a 1 in 100 year flood event sort of thing. So, you know, in terms of the unit sizes, most lenders are happy with over 50 square meters, including a balcony. So the main issue is those smaller type apartments where they're 40 squares, including a balcony. So it's like a 1-bedroom unit or something like that. So we do have lenders that will do them, but you've only got 3 or 4 as opposed to 20. So just be aware of that. I guess the point be made is that if a bank's got concerns around a the square meterage rate of a unit, the reason for that is because they couldn't sell it, or there's issues with selling it in the case of, it's a business transaction. So if they're thinking that, then maybe the people that are buying it should also be aware of that, because it will be something that comes up for people who are wanting to buy their property in the future if they ever have to sell it.
Yeah.
So just things to be aware of there.
So Pat, I'm looking to get pre-approved. Just wondering how they work, how long they're valid for, and why it's important.
Yep. So very good question. You're a first home buyer. I guess the main reason around getting pre-approval is that you can have a conversation about where you're at, and whether or not you can actually lean into this now, or you have to wait for a few months to tidy up a few things, get your savings up or whatever. So getting pre-approval gets you to the point where you're ready to buy. And then at the end of the day, some lenders will do a full assessment on a pre-approval, and some of them will do what they call an assessment electronically. So because of the market so active at the moment, a lot of lenders are basically focusing on deals that are live. So ones with a finance clause, 14 days, 21 days. So, the pre-approval process is good. It means that they have looked at it, you've collated everything, they've done a credit check on the way in, so they're happy with you in terms of, their overall initial view electronically or digitally, your footprint that you've got in the marketplace around your credit file and stuff like that. They look at about 30 or 40 things, even if it's just like through electronically, and then it's parked there until such time as you come back to us with your contract, and then we can order a valuation, agree on a loan amount, and go from there. So as long as you have purchased a property less than the amount that was agreed upon in terms of the pre-approval, because of the due diligence, the process that brokers go through to make sure that the client is ready to buy, it's really just a matter of the lender then picking it up, verifying all that data, and moving forward with it. So definitely would still go ahead with them. How long they last for? Basically 90 days, between 60 and 90 days for most lenders. And if it goes past the 90-day period, it's not the end of the world. You've provided most of the information. There's only some small data that needs to be updated. So bank statements, new pay slips, the new deposit, basically to verify that you're good to go. So, and look, at the time of that expiring, there may be another lender out there that might have a slightly different position on things. So we will review that at that particular time and roll you into another pre-approval if need be. For me, you don't want to be doing too many pre-approvals though. So you really need to be ready to start looking seriously. So if you're not ready to look seriously, maybe just hold off until you are. because 3 months can go quite quickly. Murphy's Law can happen either way. You know, you can find something in a week. You can take forever to actually find a property. So, but if you're actively looking for something, the market's in the area where you're looking at buying, like, you know, it's not too far out. You're not waiting for a bargain, so to speak. Like at the moment, you pretty much have to pay what the market's asking. But yeah, no, it's good. What was the last question you had?
The importance, and also just another one, would you recommend to get pre-approved for, say, your max purchase price that you're comfortable with at the moment, especially? And what happens if I find a property under that?
Yeah, really good question. So yeah, look, if you can stretch to, or your borrowing capacity allows you to, say, purchase something at 650, but your gut's telling you you don't really want to spend over 550, 570, you know, you may be better off maybe getting it pre-approval for the 600, 620 mark, just in case there's something that ticks all of your boxes. You love it. You're happy to sort of spend another $5,000 or $10,000 because you're going to be there for the next 10 years. You know, so $10,000 over 10 years is $1,000 a year. So it's really not a lot. So definitely get pre-approved for a slightly larger amount, or the maximum you're prepared to go to. If you find something underneath that, fantastic. We just adjust all the figures backwards. So your loan amount reduces. If you're in mortgage insurance territory, your mortgage insurance will reduce depending on the ratio. And so we basically have a conversation about how that looks in terms of your setup at that particular junction.
So Pat, what do you recommend, or what do you think is best for first home buyers when looking at a type of loan? Because I know there's a few out there, and yeah, being a first home buyer, not everyone's across the types of loans and how they work. What's the pros and cons? What are your thoughts?
Yeah, it's a loaded question. It really comes back to the individuals that we're talking to. So whether they're single, the type of income that they're on, whether they've got a family, I guess the loan value ratio, and what their expectations are for that property. Are they going to hold it for another 3-4 years? Is it their, you know, stepping stone into another property? So yeah, there's a lot of information inside of that question that needs to sort of like come from the customer or the client. But I guess doing this for 20 years, the rates have never been any lower. So my thoughts would be that if somebody can get into a loan now as first home buyers, take advantage of the fixed rates, which, like you said, are really low at the moment, like 2% or under. For some of that, probably most of it, maybe 70% of it or so, and then have a split loan with the variable portion, which is normally a little bit higher. But what you've got there is the best of both worlds. So you've got certainty around most of it in terms of budgeting and knowing exactly how much your loan's going to be costing you for a period of 2, 3, 4 years, whatever that period is that's fixed. But also a portion that's variable, so you can actually make payments to that at a higher rate. And the reason you do that is, like I said, the rates have never been any lower. They're going to go up. There's no two ways about it. At some stage, they'll go up. The average over 30 years has been 7%. So we're well and truly under that. Like, it's not going to probably get to 7 anytime soon, but it'll start getting up to 4%, you know, 3 or 4% reasonably soon after sort of 2023, 2024, I'd say. So if it was me, I would be making my payments at least 4%, like make your repayments equal to a 4% loan or a 5% loan on that portion of the variable loan. Like the fixed loan, you just leave it because that's a lower rate. Focus on getting rid of the variable portion of your loan as fast as possible. And that way, when the rates start to rise, or when the fixed rate comes off in 23, 24, and it goes to 3.5% or 4%, or whatever the rate is at that time, you're actually used to those payments. Not only that, you've also made some headway into the term of the loan. Because let's be like, nobody wants a bloody home loan. Just give me the home, you know? So the sooner you don't have a home loan, the sooner you've got more money to do the stuff that you really want to do. So look, I'll put my hand up and say, look, if I was a 25-year-old, 30-year-old, I'd definitely be making extra payments to my loan. That's where you set yourself up. That's where
Yeah.
all the gravy comes in the future, because if you can actually shorten your loan term by the time you're 50, if you don't have bugger all loan left to get to run, because if you buy a house at 25 and you've got a 30-year loan term, you're only 55, yeah? It goes quick, man. Goes real quick. So if you're at 25 and you can get your term down to 20 years, which is not a lot of extra payments, like we can work it out for them. It might be what, $50 a month? No, $50 a fortnight. It's something crazy. It's not a lot of money to actually reduce your loan term significantly. Imagine what that will do for your life moving forward if you don't have that. The trap people get into is that they basically go and see a bank or a broker or whatever, and they basically get their loan reset over 30 years ago. Again, it's ridiculous.
Yeah.
You know what I mean? Like, get yourself a 25-year loan term to start with, or get a 30-year loan term, but make your payments over 25. And then when the fixed rate comes off, then you go and have a chat to your broker. We have a talk about where you're at. You're starting a family. Yes, you're starting a family. Okay. So what are you looking at doing? Where's your money going to come from to pay your portion of your loan if you're not going to be working? Like, do you build that up in your redraw or in your offset account? Like, those types of things. But when it comes off fixed, don't reset the clock and go back to 30 years again. Like, why would you do that? Like, make it the 27, make it 25, make it, the same term. So you're basically making sure that your debt's cleared. I don't know how many 50-year-olds that we talk to, or 45-year-olds, that have still got a 30-year loan term.
Yeah.
Like, we see it every day. They come to us after 3 years being on fixed now, and they were 40, 44, and they had a 30-year loan term. They're going to be 75.
Madness.
And that's the thing that banks look at anyway, in terms of, as you get older, they do start to reduce your loan term. So I got on a little bit off target there, but it's very important first home buyers to get an understanding about, it's not just about giving me the money so I get a home. It's about giving me the money and telling me how I can pay the loan off faster.
Yeah, and set yourself up for the future.
Set yourself up for the future. Don't go and get out the bloody plasma TV on 0% interest at Harvey Normal or something, because it's 0% now, but in 2 or 3 years' time, because you've spent money elsewhere as well, that rate's going to come up. It's going to be 20%. Yes, you can roll it into your home loan if you want, but seriously, the $3,000 TV, and you're going to add it to your home loan, it's going to cost you $4,000, $5,000 with interest over 30 years. Like, anyway, we'll have conversations about that, I'm sure, in time with a lot of different people. But I certainly do want people to be encouraged by getting into the market and making some good quality, sound decisions about paying it off as fast as possible.
Yeah. But obviously, if they're not sure, have a chat with your broker. Yeah,
absolutely. And you've got the whole offset versus redraw conversation. So the offset is basically a separate account that's attached to the variable portion of your loan. It's really good for people with lumpy sums of money, commissions, or like high income earners. They can certainly make some big headway into their loan in terms of their interest savings. The redraw is just the loan itself. You put money into the loan and then you can take it back out again. So each of them do work similarly. But yeah, it comes back to the choices that people want to have in terms of the property that they own, whether they want to looking at maybe keeping that as an investment property and moving into their next home for the next 10 years sort of thing. So yeah, offset versus redraw is a personal thing. So definitely talk to your broker around how they work, how it works for you. And yeah, set it up for yourself to make sure that it suits your own situation.